Hi everyone, welcome to our market talk. As always, interesting weeks in the markets. A lot of what's happening. Market tried to go up, but started struggling. We see interesting moves in currencies and gold. I'm sure we will cover all of that, and I'm sure we have a lot to talk about. Yeah, so let's start. Ted, so we had a lot of news, some important, some not, or some maybe are important, but market was not thinking that they are important. So what's new? What's happening?
Yeah. So, definitely last week was a huge data week. Hard to keep track of everything going on. News flow very challenging, as you know. Something new every day, but lots of data out last week that kind of roiled the markets a bit. And as I've been as we talked about last time, I was on what we were on a couple of weeks ago, talked about, looking at a potential regime change. And I'm still in that mode of like trying to assess whether or not we're in sort of a change of regime, and the market talks well named here as a are we at a top or are we just consolidating? And so in order to share my screen, I need to have screen sharing turned on. Okay, thank you. Let me share my screen and walk through this. So I know we're a little short on time today, so I will try to expedite. Just from an agenda point of view, I want to touch on this regime change. Is it underway, or we have a false positive? Touch on policy, market signals, and trades as usual. Remain in Goldilocks. Goldilocks is a risk-on regime. Growth up, inflation up. This is market-based. This is what the market is telling my macro guy, not what he might say in terms of the overall, what's actually happening in growth and inflation. But this is how he's perceiving the market pricing. So we've been in a risk-on regime since mid-May. GDP came out last week. We had a 3.0 print. This is the GDP nowcast. So you see we had that steep drop off in Q1, really a function of people front running tariffs, as we find out, and then sort of normalizing plus 3.0 GDP for second quarter, and pricing 2.5% in terms of GDP now. We had, though, ISM data come out this week, and ISM manufacturing closed down some at 48, which is contractionary. It's basically been in contraction most of the time since like 2020. So it hasn't really had a good sort of run. We did get ISM services this week. That PMI ticked down to 50.1. The thing that was sort of disturbing about the report was more about what's happening with prices paid. And I'll get to that in a few slides. Last time we touched on CPI. CPI came out in the middle of July. That was an acceleration to 2.7%. And then last week we had the PCE numbers, and PCE also accelerated to plus 2.6%. The administration here is saying no inflation, but yet we do have an uptick in inflation, apparently. Core CPI, we touched on last time, plus 2.9% on an acceleration. And core PCE, which came out last week, priced at plus 2.8. And they revised up the June number. I'm sorry. Yeah, no, the May number to 2.8%. And this is what I just referenced. This is a chart that I got from a Bloomberg poster. And what we see with this yellow line, the yellow line is showing the trend in prices paid on the services side. And as you know, you guys probably are aware, U.S. economy's 82%, roughly 83% services. So we've seen an acceleration in ISM prices. And even though our president was saying you can buy gasoline for $2.40 a gallon, that isn't true. There's no place you can buy that at $2.40. You can buy it for about $3.17 in my town. Consumer expectations, this data just came out today, ticked up just a little bit to 3.1% after a nice descend. So consumer expectations are anchored, let's say, around 3%, still higher than the Fed's target rate of 2%. Five-year forward expectations have come down. So this is market-based inflation to 2.3%. So the market's saying maybe inflation will start to come down over the next 3 to 5 years. And true-flation is basically an indicator, and it's showing 1.75. It's toggled between 1.5 and 2.25 over the past several months, but basically showing inflation tame, under control. We had a Federal Reserve meeting last week. This is an unchanged chart. They continue to keep it tight. The Fed came out on Wednesday, and basically some of the things that they said from this July 30th statement was that GDP rose at 1.2% pace for the first half of the year. So if you take the negative print from Q1 and the positive print from Q2, and that's down from 2.5% last year. The growth of economic activity has continued to moderate, and they referenced a slowdown in consumer spending. On the PCE side, they just referenced what I just did, that prices are firm at 2.5% and PCE prices at 2.8%. And then, of course, they didn't have the benefit of the employment report, which came out on Friday. The unemployment rate at 4.1% remains low, and wage growth has continued to moderate while still outpacing inflation. So they basically got us in a stagflationary economy. And then we had Friday, which was the payroll reports, and it came out massively below expectations. The print for Friday for July was 73,000 new jobs were added. That was well below expectations of 110,000. And more importantly, they had a total of 258,000 in jobs were revised from the previous 2 months. So it was really a negative report. And had the Fed had this information, there may have been a reduction in the Fed funds rate, but it did not happen. From a policy point of view, basically the Trump policy is you're fired. So they basically referenced the Erica McNabb, whatever her name is. She faked the job numbers. She's directed her teams to fire her immediately. He indicates the economy is booming, and then of course has to say, Jerome too late Powell should be let go as well, but he hasn't done that. So this is the policy response. We don't like the data. We're going to change the inputs to the data, apparently. So this is what we're living in right now. From a signaling point of view, I mean, as soon as that number came out on Friday, this is the 2-year yield. The 2-year yield basically imploded, went from 3.975% all the way down to below 3.7%. It's since come back a little bit, but just a huge move in the 2-year yield, and clearly market pricing some concerns about the growth side of the equation. SPX also took a hit. It basically had a 2 standard deviation move after having put a new high in on Thursday. Actually on Thursday morning, sold off, and we had and I pointed this out on a subsequent slide, but we basically had a series of higher opens and lower closes throughout the week. So 4 days of higher, basically opening at the top and closing down, open at the top, close down, open at the top, close down. And then, of course, we had a big sell-off on Friday. US dollar, which has been kind of moving in the right direction from my point of view, took a big hit as well. So that was down pretty sharply on Friday, down 83 basis points. And then the VIX, of course, ripped only to pull back as it sort of got up against the top end of the trend range. So we had quite an interesting day on Friday, and I was in heavy duty risk management mode at that point. While the previous week I was selling, at the highs of a lot of my positions, they're basically at the top of the range or breaking out. All of a sudden, we had a situation where, with tighter stops from the previous week, I ended up having to do some selling. So I asked the question, on the 31st, is regime change underway? I know when my stops are being hit. Return drivers for me this year have been international, metals, and FX. And over the past 3 weeks, a number of my positions have started to have stops getting hit, and I'm out of most of these positions at this. Actually, I'm only in GLD. I'm still in GLD. So a lot of sort of movement and risk management, which My stuff is early because I trade tight with my stops, and really we've had this vol compression scenario, which has kept realized vol tight, and my stops are tied to realized vol, and so I've been basically looking at what's happening. This happens oftentimes as regime change is underway. So I pointed out earlier in the day on the 31st that we had this situation where this is the fourth day in a row where the SPYs opened higher. You want to use SPX, it's the same thing, open higher, only to fade throughout the day. And so by 2 o'clock in the afternoon, I got long VIX calls. I got the long the 919 VIX calls, and I'm going to go to that in a second on trades. So as we look at that trade, I put that on Thursday. I put on a VIX 919, which is the quarterly expire 44 call. So it was trading in mid 42s. I got that position for $3.69 per contract on 7/31. I woke to a pretty strong move after the employment report up, and took my position off by 10, 11 o'clock. I think it was 10 o'clock at that day at 496. So I had a 34% return on that. It was a hedge position. So I got out of that position pretty quickly, and it worked out pretty well in that we haven't seen, it basically traded down. In fact, when I sold it, I thought, oh shit, I left money on the table. But really it faded pretty quickly. Not all my trades are as good as that one, for sure. Just want to revisit some of the big macro charts. This is the same chart we've been using for a while. I got long here at the end of the week of the 7th, on the 11th of via UUP, added to the position on that Monday, the 14th. And basically this thing has been UUP, which is a dollar proxy, has been moving in the right direction for me. We've got this nice pullback, which happens often. It held a support area, put in a big higher low, and then proceeded to rip higher. And actually, when it was trading here, had inflected bullish in my work. And so as this thing pulled back, yesterday I actually added at 27.41. A little underwater on that at 27.38, but so far so good. My stop is I don't know where my stop is. Doesn't matter. It's in this range here, so I'm still good with this position as it pulled back, and so I added yesterday. The other thing I just wanted to note, this has been my FXF position. It's gone back. I've talked about this over time. It's just representative of a number of different FX positions that I've had. And I added to my position in late July, basically a low end of the range. It was really close to where my stop was. I added the position, and then immediately it got stopped out and sold it over the next of the subsequent 4 days. So stole it here, 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 and here. I'm now out of FXF. I'm out of FX. What was the other one that was recently open? Was FX. I had B, but I've been out of that for several weeks, which is the pound. But this is the Swiss franc, and so basically out of the Swiss franc. I did, however, this is the weekly chart of FXY, which is the yen. I got a signal on my weekly chart to get long last week, so I always take out when I do that, I get a small position. I put that position on here into Friday's close. I'm still sitting on that position. It's a small position because it's a counter trend. It's a counter trend trade, and so this system that I use, where I use this weekly chart to get long when I get a signal from a very oversold level, I get in. And then it's a low risk position, and as it starts to move, as it starts to reflect higher, and I get pullbacks, I'll add to that position if it doesn't get stopped out prior. SPY, we've looked at this chart, got long back on the 11th of April after Liberation Day, added to the position, sold along the way, and then last Friday, on the 1st, I did get a stop. So as you guys know, I take when my stops are hit, I take a quarter of the position off, and then I wait to the next day. If it's trading below my stop, which it's not currently, I I take more off. If it goes back above my stop, I still have 3/4 of my position intact. So that's where I am with SPY right now. I am long. I am holding. My stop is still there, and if it needs to be adjusted, I can do that. So here's my list of stops. These are like all my positions, which you don't want to know about. But so my SPY, you can see, got hit on the 1st of August. My stop's at 625.23. Don't go stop running on me. So I don't keep my stops are not in my trading platform. They're outside my platform, so that I don't get into trouble with stop runs. And then EZU, which this actually is long Europe. I had gotten a stop back on the 20th of June. I got back in at the lower end of the range. It was still bullish. It is still bullish. I got back in. I added a big position here, which was on the 21st of July. I sold a little bit here because I had a quick pop, just took a little 10% of my position off. And then what happened is stops hit, and I've been out, and I'm totally out of EZU at this point in time, which sucks in that, it has continued to roll higher. But it is what it is, so I'm out. Similar positions to that would be EFA, which is developed markets. Basically trades very similar, and I'm out of EFA as well. Crude oil. Crude oil, not trading well. It chops me up a lot. I got long PBDC, which is a commodity ETF, largely energy related. Got long here, added here. This is inflected bullish. I added a big slug on the 4th, which was Monday, because it was trading really close to my stop level, which was at 1304. And I was able to get a position in, I think it was at 1310, something like that. And knowing that it was close to my stops, and it basically got stopped out. And I'm in the process of stopping out. I have 3 strikes right now, and 1/4 of the position is left. So not working well for me at the present moment. Gold, we've talked about a fair amount. Gold appears to be sort of in this consolidation range. The last trade for me was this hedging that I did. Took the hedge off, and of course, as soon as I took the hedge off, the thing went down again. But it's just, as far as I'm concerned, gold's just chopping around in a consolidation range. It's going nowhere. I remember, Vi, we talked about this a little bit. You said nowhere. We were in no man's land. I think we were on the 22nd when we last met. We were in no man's land, and basically it remains there, just chopping around. I don't know if the trend is going to inflect higher, whether we're going to break out. Certainly, gold miners have broken out, and today I noticed that silver, SIL, silver miners have also really broken out strongly as well. TLT. I did get long this position, TLT, on the 1st of August. It inflected bullish for me. I don't love the position. I bought up here, having sold down here. It's not, as I looked at it, I was like, I don't like what's going on here, but it did go bullish on me, so I am long in a starter position. Other positions that have been working much better for me in the space are EMB, which is emerging market bonds, as well as IEF, which is the 10-year. And of course, we talked about this last time. This is HYG. This thing kicks out a 6% yield and just keeps rolling higher. So I did add my last position on the 15th of July. That and LQD, which is corporate bonds, appear to be holding up along with stocks. And it does trade pretty well along with equities. So it yields 5-6%. We talked a little bit before the show on FBTC. I did get a sell signal on Friday, along with a bunch of other stuff for Bitcoin and FBTC. For me, that meant taking off 1/4 of my position, which I did right here. Obviously, it's continued to, sold off a little bit, but didn't hit my stop. And so we continue to have 3/4 of my position open at this point in time. And that's it. That's where we started. So that is where we will stop.
Thank you. Great as always. Yeah, gold is definitely at an interesting spot. During last show, I draw some drew some lines on a chart. We will revisit them. But yeah, when it comes to economic numbers, one thing I never understood about the US and how it works is all of these revisions. I don't even understand how it's possible. You either hire a person or you don't hire a person. What does it mean? Yeah, but just a quick
The
note. Yeah,
lies,
I
damn
I
lies, and
heard.
statistics,
Yeah,
right?
I'm not an expert, but I heard that unemployment rate in the US is like a survey or something like that, which is correct.
It is a survey.
I don't
It
know.
is a survey.
For my brain, it's very hard to understand because here, I mean,
I know
if
because
you
the employment data is available. The state data is recorded, but there's a lag, and so they
exactly
use
because
statistical
I don't know
analysis to.
in Europe, I mean, if you are looking for a job, you go to the job office or however you call it, and you register. If you are hired, employer also files it with some of the. I mean, all the data is available. Anyway, yeah, yeah, just wanted to mention that. But yeah, great. So, Raphael, so is regime changing or not?
So yeah, I'm definitely more bullish than you, Vi. So I don't know what you're going to talk about today, but from your tweet this week, seems that we may be in a disagreement. Yeah, I'm still bullish. I mean, I expected the move up in VIX to MFR trend, and this is what we got. Ted played it perfectly, and yeah, I'm back being bullish. I'm gonna go through the charts again. The volatility regime is different from the one we've had before, but we are still not in a regime where I expect a big spike. So let's go through the chart and let's see when we get there in the VIX. So, up, let me clean the screen. Okay, so yes, I started to unload as we were approaching one of the level you actually mentioned to me. I guess you will talk about that level. It was 6402. So I started to unload as we were approaching 6,400 level and took everything out as we reached the monthly target also that you provided to MFR elite users. It was 6445. It was very good target to get out as after we reached that target, market started to go down. In the meantime, I will go to VIX after to show you, but we started to see some changes in the VIX, indicating that a move up was getting ready to happen. So very timely out. I was looking to get back in, and we got a confluence on the first day of August. Several stuff happened. We had first, it went below the low of the range. Of course, if you update real time, you will see the range go down as the price is moving down. But you can see it here. The candle was below the range. So this is very unusual. So you would expect to get an opportunity to buy the dip when this happened. You also had, so this one is the monthly target. So it hit the monthly target. At the same time, it was hitting the quarterly open. So I'm going to show you the quarterly open. Okay, this one in blue here. And you also had daily and weekly targets. These ones, they are not available. But you had all sorts of confluence. So I was quite confident buying the dip here. So I went back in at 45. And I'm actually trying to add more. So today I tried one time as we were reaching the monthly pivot, got stopped as the market kept selling. And I tried one more time before the close. So far, this ad is holding. and I'm for now quite confident that we are going to move higher. One thing I like is that the spread between the low of the normal range and the low of the long-term range is actually diminishing. You can see it quite clearly on NQ. Sorry. I mean, you can see the spread was huge in May and see the spread now. In my opinion, this is very bullish. I've mentioned several times that I'm waiting for both low of the range to join to indicate that the next run is gonna materialize. So I'm basically preparing for this next run. Of course, I'm gonna add if we get some cap to the downside. One worry I have is the fact that for now we are not seeing upside materializing. So the range, top of the range is stuck in the where the previous month's bull target was. Upside downside ratio on the MFR website is not that good. So I want to see some upside actually start to materialize. But this is just, let's say, the bad points I'm watching. So I'm expecting this thing to keep running and to actually offer upside downside ratios that are more favorable to bulls. So that's number one. Now I want to go to VIX. This way I can connect the dots. So like I said, I was expecting the retest of MFR trend. This is exactly what we got. It's what we got at the same time that we were getting the ES sell-off and the retest of all those levels. So very good place to buy the dip. Now my expectation is a vol crush. So basically VIX back in the 15th. I'm still not expecting some kind of VIX move up, significant move up before at least the end of August, maybe the beginning of September. So basically, to make it simple, I'm waiting for volatility trade and volatility trend to cross. For now, we are not anymore in the where we were before. So I have explained that 2 weeks ago. So we are in some kind of like chop or monitor your position phase, but we are still not in a place where we would buy puts for deep sell-off. We are still in some kind of buy the dip place, in my opinion. So if history repeats, vol crush, maybe some chop, but at the low of the, let's say between 15 and 18 for at least a month. And then we can start to see, to maybe take a position for good sell-off in equity, move up in VIX in September. Now let's go to the XY. So I kind of agree again with what Ted said. So we got the first rejection. It was at the last show at MFR trend. The same thing happened at the end of July. Tried to go bullish, stayed there for 2 days, smacked down. And now it's confirming again that we are breaking back to a bearish trend. I'm waiting for volatility trade and volatility trend to cross before taking a bet for the dollar to actually have clearly bottomed. So again, it's same story as before. I want to play the Euro USD short. For now, we still haven't reached the minimum daily target for trade of volatility for me to be interested to short Euro USD. So still waiting. I want to show you UP actually because this is the instrument you can trade. DXY you can't. So you can see here trade and trend are getting near to cross. So expectations would be maybe third or last week of August. So this is when maybe it will get interesting to trade FX. CL, same as 2 weeks ago, no touchy. It broke MFR trend. It was not breaking 2 weeks ago. Now it's clearly breaking. It's not looking nice. And I was looking for Brent to confirm before taking the long CL. And good thing I didn't initiate this position because Brent is also confirming the break to bearish trend. So CL no touchy. I think the setup will come, but for now it's not to the long side. Vi has mentioned gold. Actually, gold hit its quarterly open. It's in this vicinity. Sorry, I don't have the price in front of me. Also hit the July settlement price. I think it's 332 Vi. And as soon as the monthly candle opened, gold just kept running higher without looking back. So you had a big zone here of support. So it broke on the 28th, started to reclaim some of those levels on the 29th. And since the beginning of the month, we are just ripping higher. So I'm not sure users had access to JC levels when that was happening. I know you added this ticker now for elite users. This was, for example, a setup you could have taken, especially considering that volatility was starting to make, this is a blue line, lower high, lower lows. So you had volatility on your side. I hope you took that trade. Now to Bitcoin. So Bitcoin, unfortunately, I got stopped out on the 1st of August. The reason is pretty simple. If you watch the previous shows, you have here in black, it's what I call the volatility box. So I need the volatility of Bitcoin to be inside that box to consider that Bitcoin is in a bull market. Okay. So as soon as volatility of Bitcoin broke outside that box, I was out. So far, it seems that we got the bounce at MFR trend, and Bitcoin is supposedly starting to take another run higher, but I'm not getting back in until I see volatility back inside that box. As soon as it happens, could be tomorrow, could be I don't know, this weekend, maybe next week, I'm gonna get back in. But I need volatility to get back inside that box. This is when I know that the next run is opening. So got stopped out. Now it's higher than my stop. I don't care. I want the volatility back in the box. Something also very interesting happened since the past 2 weeks is the fact that so the 2 years, the 10-year, 30-year broke trend. So I hope you noticed. For now, we are still inside the box where we've been trading for like since beginning of April to 2 year, 10-year, and 30-year have not moved out of this chop. So we broke trend, but will we get outside of that box? I have no idea, but I'm monitoring that. The break of trend was significant, but we are still in the box. So until we break that box decisively, I see no fundamental change regarding bonds. And one last position I took was actually Tesla. So let me show you. So it's in gray here. We had the monthly open actually held quite nicely, being retested several times. We also had the quarterly, I think it was the quarterly open, if I'm not mistaken. yeah, also held here. So I'm playing options. I'm playing lotto calls, and bought some Tesla here, bought some Tesla here. So far, it's been working nicely. That's how bullish I am. I mean, I'm sorry, bye, but yeah, I'm still quite bullish. And I when I saw that, I thought, okay, this is a good play. I'm looking for 330 as a target first, and by the end of the year, probably much higher. But 330 is a significant place I'm looking to unload. So yeah, that's it. It's quite concise, but yeah, I'm trying to stay focused as we are, in my opinion, moving. We are still in the second phase of the volatility place that I've mentioned. So I'm trying to stay focused. I'm trying to play the plays that I think can generate money. So that's my take. Thanks, guys.
Great, Raphael. Thanks. You don't have to be sorry. Why? Great trade in Tesla, and yeah, it's summer, and even though we recently had quite decent volumes in futures, but overall they are lower, and yeah, anything can happen. Market can go higher, and it can keep grinding all the way till September. Maybe we will see. Uh, yeah, I'll try to keep my piece to the point. A lot of stuff happened, but actually, market is trading at very important levels and very important spots, and same basically scenario as we had 2 weeks ago. Maybe I will start with gold. If you watched, yeah, this one we don't need. If you watched the previous show, yeah, so I was talking about a couple of prices in gold, and one of them was this 34.60, and yeah, the market that touched it. Now it's breaking, so breaking above. So regarding gold, it's a pretty low risk trade if, for example, you would initiate it somewhere here, but yeah, we can go a couple more percent at least easily in gold if gold continues going up, and it looks like it. So at least to the previous high of 35.10-ish. But another spot will be 35.40, which is also an important level. But yeah, gold was nice, and the July expiration price was 33.23, and previous was 33.32. So yeah, these levels work like a charm currently because price is coming back, and also we had a rollover, and it took only a couple of days for new front contract to close the rollover gap and to come back to exactly that settlement, and that was an amazing also spot to watch. But yeah, this is the situation with gold, and be very careful. Be very careful shorting that, or if you do, then do it a bit below, not here. It's crazy. I think that the market will try to make a new high in gold. Yeah, so just keep that in mind. Now we will continue with the overall situation and why I am a bit concerned about the next leg of the market and the next leg up, or at least why I'm not expecting some big up move is, of course, stock bond correlations, and finally uh, correlations are breaking. Stock bonds correlations are starting to become negative across shorter time frames and lowering significantly across longer term time frames. And as you already mentioned today, at the same time, bonds broke MFR trends. So when we put all of this together, and also from the overall regime metrics that I use, stock bond correlation negative would mean a more normal regime, and maybe we can expect a rotation and some pause in the bull run in the equity markets, and maybe some bid in bonds. So that's what. And I also see some signs, some potential signs of bid in bonds, especially in the longer end ZB. But yeah, correlation is very important, and SPY TLT correlation currently is minus 0.3 on a 10-day, but of course 10-day is really low. So if we go to 21-day currently, let's let it recalculate. And yeah, that's what I was mentioning, and I'm looking at it every single morning when I do my preps and overall analysis for the markets. I always start with correlation matrices. Always. It's the most important thing for me to know immediately what changes. Of course, I start with lower time frames because these time frames are where the changes happen quickly. Of course, more noise, but at least you can see that there are potential changes. But yeah, 20-day correlation SPY TLT minus 0.18, so negative. Just keep that in mind. And now we can take a look at the chart. I have this quick tool, which is always measuring against the SPY. So of course, it doesn't make any sense to have SPY against SPY. So I changed to TLT, and yeah. So this one is a 10-day, like we were talking about, and of course, cycles and short-term flows and short-term correlations are small ones, and they change quickly. But yeah. Sorry. Now we have a nice move down in stock bond correlations, and that alone would not be something that I would spend a lot of time talking about. But 21-day is a different story, and 21 days is quite a significant period to measure already. And yeah, we have a sharp move down, and for now it doesn't seem that that it wants to stop. And just quickly, the macro regime, just for us to see, because this one is slow and is not changing a lot. But basically, we are currently sitting at almost no correlation between stocks and bonds, which is, let's call it 0.8, 0.08, 0.09. But yeah, if that continues, we can even see this number going negative as well, and that depending on other asset classes, that would mean normal regime, but normal regime can be either stocks up, bonds down, or bonds up, stocks down. So yeah, we will see. But it's very important, and today I'm not talking much about average sector correlation to SPY because it's very low. Markets are not crowded, positions are not crowded, and we are in a lot better spot than we were before. Average sector correlation to SPY of 0.52 is absolutely low and normal. So this can move markets upwards a bit. But this was what I wanted to start with, and to say why I am not so sure, and I'm monitoring the situation daily, and you should too. I think because stock bond correlation is a great macro indicator, great indicator, and I suggest you play around with it, and hopefully it will be helpful. Yeah, so let's go to stocks. Yeah, of course, we have plenty of unfilled gaps, and below market always fills them. But of course, the question is when we are looking at the ranges. When we're looking at the ranges, of course, we are in the middle of a longer term range, and on a regular term range, we're also in the situation where it's either up or down. I would definitely not be executing at this spot. Raphael covered targets very well. So, yeah, we had a market trading both at the bottom, first bottom target, and the upside target, and these were places to trim some positions or to add to some positions if you were doing that. And I covered some of these things on my trading plan video available in the trading plan section. So just not to repeat myself a lot, but basically what I expect, I actually expect a move down maybe to 62 or mid 61 handle area in ES futures, but one day at a time. At least for now, we see this chop up and down. Market is struggling to make new highs, and now we are, even though this distance from all-time high is only less than 1.5% or so, but still, market is struggling to do that, and we will see what will happen in the news front, in the tariff front, and so on. If the market gets some push or not, but I would expect market to test maybe at least bottom of the regular term range or even lower. And we have some targets that are published on a trading plan section also in this area. So that's what I would expect. And I'm not calling a crash, I'm not calling bear market, but today I wanted to make the point of my piece that now chasing the longs is not the time. Is not the time for us to consider chasing longs. I don't know if this word should be used in a risk management show and so on, but it's better to chase if the market makes a new all-time high. Believe me, statistically, it's way better. But I would be looking for a adding to equity longs if we get a couple more percent down move in equity indices. And one thing to mention is that this last month, NQ is actually not outperforming the ES, and best bull market signals and best moves happen when NQ is stronger. Of course, it depends on how you measure. If you measure from April low or from yearly open, then maybe you would see a different situation. But overall, in the short term, it's not NQ. NQ has a lot of choppiness and volatility, and also in your sheets you can see, for example, in the quarterly sheets, QQQ and SPY targets are available. You can see, for example, what SPY managed to achieve already and what QQQ managed to achieve already, and you will see that SPY is in a better spot. So that's also concerning, because if there are any shake-ups or volatility in MAX 7 or in tech and so on, yeah, NQ will lead all the stocks down a little. So just in case, if you're long, take some profits and leave partial positions. Take some profits at the targets, but if you're just planning to think that you missed something, and you just want to, you are looking for a spot to buy stocks, maybe today is not the day. We will see what tomorrow brings us. So I don't know if that counts as disagreeing with URAF. I'm not saying that market will have a very, very hard crash or something, but yeah, I just think that the potential move, if market continues grinding higher and or just going up, the potential move this August is not huge. Let's call it. It's not big compared to where it can go if things go south. So this was just my point. But today, my main point was stock bond correlation. Watch that, and we have some signals I will not repeat them, but because guys already did a great job. But we have trend changes in some bond-related assets, and yeah, watch that because this can change situation very quickly. Of course, short-term correlations will not change the entire regime or entire longer term trends, but changes in short-term correlations, if they stay, will lead to changes in longer-term correlations. So keep that in mind. Yeah, that's it from me. But actually, I thought that it's important. For now, I agree that oil will most likely try to go down maybe to 62, 61 area on CL futures, and yeah, it's a tricky situation with stocks, and the best trade maybe can be gold, but also with a very strict management and executing in the right places. Yeah, so hope it was useful. Thanks.
Yeah, there are questions, right?
Great.
So, Hani is asking, can the targets be added in API requests? So no, they can't, but Vi made it so that it's a Excel file. So I mean, a couple of lines of code, and you can probably feed whatever.
Yes. If you are, first of all, yeah, if you are using my fractal range API, it means it will be easy for you to feed that spreadsheet into Python. And but I explained both in the video and in other places why I decided that it's spreadsheet, because it's very dangerous. I know that you will. I'm not talking about the offer of a question. I'm speaking in general that people will, yeah, then they will put it on trading view or whatever, and oh, this stock is at the target. Oh, this stock is at the target. Let's buy some. Let's buy some. So it will lead to a disaster if you. But when you already want to execute, like I explained in the video, to execute in the stock, you have made all the due diligence of your ranges, trends, and you are really interested in that. Yeah, then it's very easy to check the target in a spreadsheet. Maybe in the future I will just make it even easier, same thing, but just to have multiple tabs in the same spreadsheet, like annual, quarterly, monthly, because technically now it's free spreadsheet, but still it's very easy for you to just copy paste them. But yeah, my biggest concern is not that, because of course it's possible to add targets to TradingView, it's possible to add targets API even, but I'm afraid that it can be more harmful than useful. So at least for now, regarding the question, for now it's not planned, but we'll see. We'll see if users start requesting a lot of international tickers and other stuff, then maybe we will find a solution for that.
Yeah, another question, Vi, could you please comment how to use monthly levels in the context of quarterly levels? He's giving an example with GDXJ. He says it hit the monthly bull level today while remaining below the corresponding quarterly level.
Oh yeah, I believe I spent half of this weekend's video trading plan video talking. But yeah, what ticker was that? I'll do a quick example.
GDXJ. It's a junior.
Yeah, I know that. So
So monthly level in context of quarterly levels.
yeah, so now I will quickly just. So he said that because I don't have the proper targets on TradingView currently, but
Level while remaining below
yeah, doesn't matter. So it reached bull level. Okay, so let's say that blue lines are Uh, Good. Whatever that is. Let's say this is a bull monthly level, and let's say that this is a quarterly level, which I believe that was the situation. So the main point of the entire process of managing winners and managing positions on the winning side is a scaling out. So of course it depends on your position size. Do you have a runner, or maybe it was the size that where it was only possible to close out it entirely, but most likely not. So if you are scaling out and you see a break and a break above the level, now remember these are random lines just for the sake of example. But yeah, if you see bull target breaking and you see a quarterly level to the upside and you have a runner, it's a good reason to hold that runner a little longer. And then again, depending on uh, your exposure at the quarterly target, you will either close it entirely or again, you will take partial profits. Because that's the entire point. We are very aggressive risk managers on the losing side. So, of course, never holding losers, never, God forbid, never adding to losing positions. But when you have a position which is already working, so again, depends on your situation. But when you have a position that is already working, it's really doesn't make any sense for you to, for example, close the entire position if you have, if you can leave some runner. And yeah, why it's important to scale out? Because yeah, of course you can think, oh, I will just not sell. Yeah, but then if the position comes back to your entry price, you will not make any money. But when you are scaling out along the way, it is it just makes sense because even if your runner remainder comes out, you already took some profits. Yeah, and adding to the positions, I would add actually. Uh, I would only be adding in two scenarios. That also, I believe, I covered with NVDA or other tickers in this recent trading plan video. But adding to a position, I prefer to add on the break of the base case monthly when it comes to monthly, and then ride it to the bull case. But in the case when we are already above bull case monthly and we have quarterly ahead, maybe I would not add to the position this month because basically it had a huge move this month already because it basically reached two goals. I hope it answered the question, but I recommend if you haven't watched the recent trading plan video that was posted for the month of August. And of course, if you have any questions, because we really care in this new offering, we feel a responsibility because all these targets, they will only be useful if you really know how to use them. So if you have any questions, just send us an email. I will always reply if, and explain. But this is the point that we have a runner, and it's good that you have a quarterly target above, and yeah, that will be next spot where you can trim a little.
Yes, some user asked me a question regarding how I use VAI levels together with volatility indicator and FR risk range. So yeah, okay, I'm just checking if my mic was working. So yeah, I'm checking actually for confidence. So like I did for yes, I'm looking for confidence. I want probability in my on my side. So if for instance you have a low of the range, you have the monthly target, you have quarterly open. I mean, you add and you add and you add and you add reasons to take the shot. Then you take it. So VAI level just give more confidence because I've tried them now for 2 months and I know they are working quite nicely. And you mentioned COPX. So actually, I checked COPX, and you say it came close to monthly target while being still in the middle of the risk range. Actually, I'm checking COPX, and what you had was it actually went through the bear case monthly, tested low of the range, almost tested the low of the long-term range. So it was a good spot to, if you are like, if you have a bias, if you have confidence. Also, the fact that it was retesting MFR trend. So, we keep adding the reasons why you had a probability on your side. So, in that case, it was not in the middle of the range. It was literally going through the static low of the range and almost testing the low of the long-term range. So, that was an easy trial. In that case, what you do is you put your stop very close to your entry below. For example, if you took the low of the range, you can try to put maybe just below the. In that case, you also had the retest of my volatility daily trend, so it could have been below the volatility trend. But so not sure the example is appropriate, because in that case, a long was appropriate. So again, you are looking for more. You want to increase your probability to have a winning position. And Vi calls it a cheap. I think a cheap position. It's basically
Yes.
what you take, and the potential for losses is small. The amount of money you're gonna lose if you're wrong is small. So you are increasing your chances to actually make money. Hani asks, so that's for you, Vi. Are there good resources for understanding correlations and regime shifts? Vi mentioned tidbits here and there, but any good books or papers that are more exhaustive?
Oh, yeah, stock bond correlation is very Googleable, and start with papers. If you Google that and the resources, public academic papers, it will be great. But actually, you don't need books about correlation. Correlation is very simple. How you use it is not. So stock bond correlation is definitely a Googleable topic. I will maybe if I don't forget, I will try maybe to find some good, because I have read a lot, but now I can't recommend anything out from memory. So maybe I will find, but definitely not books. And regimes itself, the good long buy. I believe that's how the book is called. Very good, good one. Howard Marks' book on cycles is also good, but it's definitely not the resource just to understand stock bond correlation. Basically, I can explain very simply. On the long term, so let's say 252-day correlation, when you are measuring, if you see strongly positive correlation, it's a about positive correlation regime, which is not normal, which is not normal regime in the long-term history. You would expect stock bond correlation to be slightly negative. And of course, I combine it with multiple time frames, because that's what I do with basically everything in my process. That I look at the same things in a lot of different time frames. But stock bond correlation is something I look at every single day, and for a very important reason, because when bonds break the trend, and you see that correlation is starting to get negative, and overall trend in correlations is down, and actually stocks are trading at very important levels on the upside, where it may potentially be very hard to crack. Let's call that. It just is a warning sign for you that now maybe it's time to trim some stock. Just another confirmation, but because of course cycles happen. When we are measuring cycles in years, for example, average cycle in equities based on fractal models and rescaled range analysis is 4 years. It's what fractal models say that average cycle in equities is 4 years. But these I call macro cycles, and I know that people will use macroeconomic data for that, but it's in there. Bond prices and stock prices, just stock bond correlation answers all the questions that I have, at least in my process. So I use it as a macro cycles. So of course, cycles happen in different time frames. So I start with 10-day, even 21-day, but the overall big cycle is you need to use way bigger time frames and maybe use futures on TradingView. ES versus EN, for example, because these reflect a little better. But it's the same thing. So I hope answered. But I don't know. I can't promise, but maybe I will find something because cycles, cycle studies, you can find plenty of resources. Correlations is not something you need a book about, but yeah, there are good academic papers for sure.
Okay, we're good. No more questions that I see.
Yeah. I hope it answered, yeah. But actually, it's interesting. If I don't forget, maybe I'll search because I know that in the past I have read a couple good ones, but I really don't remember what it was.
Okay, got it. So thanks, guys. I guess we meet in 2 weeks, and let's see where we at then.
Yeah. So thanks everyone. Yeah, and thanks Raphael. Thanks Ted, and manage your risk and good luck. Bye.
Bye bye.
I know.